Hi, this is Steve. I thought I might give you an update on what the markets are doing right now, especially in light of the turmoil in the world of late with the Egyptian protesters in the news so much. Anyway, let's take a look first at the bond market. On the screen, I have a chart of the 30-year U.S. Treasury bond, or it's represented by the symbol TLT, an ETF that mirrors what the 30-year bond is doing. Right now, we have a yield on the 30-year bond of 4.7%, and that yield has been increasing. Yields are moved inverse to price, and we see that since September, the price of the long bond has been coming down. It has dropped rather dramatically. It looks like probably about 10%. This is an area that we are not involved in, and of course have been aware that the problem with the decline has been going on for some time. Let's compare that with high yield funds, or sometimes called junk bonds, lower quality bonds. Now, lower quality bonds or high yield bonds really don't take their cue as much from a change in interest rates, or rising interest rates are less of a factor than a rising stock market and a rising economy. So consequently, the high yield fund is doing well as the stock market does well. We currently have a 7% yield, and the direction is from lower left to upper right. We have a relatively low volatility upswing, and that's just fine for our bond position. I might add that along with the high yield funds, we also are using something called a floating rate bond, performing well at the moment, as well as convertible bonds. And so I'm happy with our high yield. I'm happy with the GWM flexible fixed income folio as we have it invested right now. I'm going to move on to the stock. Well, I'm going to do a comparison, a short comparison here. This kind of shows you what the high yield bonds are doing compared to corporate bonds. Munis, of course, are in the tank, as well as treasuries, and corporate bonds are going just kind of flat. So we are invested in the right place at the right time as far as the bonds go. I want to take a look at the stock market here. We have been in an incredible uptrend ever since September, and that kind of coincided with Fed Chairman Ben Bernanke's announcement that he was going to use a tool called quantitative easing. Essentially, he was going to print money and buy bonds, corporate bonds from the banks and whoever, and thereby pumping liquidity into the system. And he did it with the intent to raise asset prices. Well, that's exactly what has happened, and it continues to happen. And we have on our hands a very nice, strong uptrend that couldn't even be really knocked off from the problems we're seeing in Egypt right now. On the screen, I have moving averages. The 200-day moving average is sloping up. A 50-day moving average, it is sloping up. A 20-day moving average, it is sloping up. And a 10-day moving average, it's sloping up. All these time frames are aligned. And that's what I like to see, and that's where I like to remain fully invested when we have alignment of these various time frames. This means that day traders are buying, swing traders are buying, position traders, long-term investors. Everyone is in alignment, going the same direction, and that's up. It seems that there's a couple times a year when the market will trend real strong. We want to be involved at that time. And there's a concern, I have it, and many do, that a correction is due, but you really can't worry and become all uninvested worrying that a correction is coming. We have the risk management systems in place to get us out of the market should a serious correction take place or something worse. You are aware of our stops, smart stops at that. that we apply to each investment that will give us a signal to come out of the market should it violate our maximum loss we're willing to accept. So the better thing to do is to remain invested and wait till those signs really come through and perhaps even stop you out. I am optimistic. We have the Federal Reserve continuing to pour money into the system. The real economy is getting better. I put a blog out just recently or I think it was the last newsletter, and I talked about the government reports showing that the economy has been gaining every month for the last 20 months, 18 months, and it's pretty consistent. At some point, I think we're going to get some job growth too, but it's always a lagging kind of deal. Jobs come after the recovery starts. Anyway, hopefully this kind of gives you an idea how I feel about the markets right now and what they're doing.